Good morning, everybody, and welcome to the January edition of our Economic and Investment Update. My name is David Baker. I'm Chief Investment Officer here at Mazars, and I'm joined as ever by George Lagaris, our Chief Economist. So thank you for joining us this morning. We'll take about probably half an hour, 35 minutes to talk through the slides. I'll give a little introduction, then I'll pass to George to give them the main part of the presentation. Then hopefully we'll have 10 minutes at the end where we can take some questions. We've had a really good number of questions through in advance, so we'll try and get through as many of those as we can. We probably won't get to any questions that people want to post in the course of the webinar, but if you do have a question that you really want to ask, feel free to put it in the Q&A rather than in the chat. So without further ado, let's move on and look at the headlines. What's happening in the world and what's happened since we last spoke towards the back end of last year. 5 points. The first three probably go together, really. So I'll take them as such, and maybe start with the third one. Undoubtedly, the global economy is cooling. All of the leading indicators that we track in the team are telling us that economy is pretty much slowing around the world, probably with the exception of China, for obvious reasons. And that's showing up in the leading indicators. It's showing up in surveys, whether those are corporate or consumer surveys, and it's now starting to show up in the hard data. And you've probably seen, if you're keeping track of the news, that you're starting to see it happen in the corporate world too. Some layoffs, principally in the banking world and the technology sector, but it's absolutely evident that the economy is cooling. And of course, the good part of that is inflation is starting to fall as we see some of the supply side factors of inflation falling out of the calculations. So what does that mean for monetary policy? Well, we can probably say with a fair degree of confidence that we're getting towards the end of this rate hike cycle. So there's quite aggressive rate hikes that we've seen from the US Federal Reserve, the Bank of England, and the European Central Bank. We're getting to a point where we think that those are going to start to taper off and ultimately cease in the next few months. So that's not a given. We could see surprises in the economy, but if inflation continues to come down, then we think that rate hikes are going to cease. So off the back of that, turning to the first point there, markets really in reasonably buoyant mood in the last quarter of 2022, and we'll look at some numbers a little later on. So remember that markets move ahead of the economy, or at least that's the idea, and therefore even though you've got some reasonably negative economic data coming through, not catastrophic by any stretch of the imagination, but reasonably negative, markets are looking through that and looking ahead to what corporate earnings might be in the second half of this year. So as I say, rates we think are going to level off. However, that's not an absolute given. As I said, you could see inflation being a little bit sticky because you're still seeing reasonable amounts of inflation in the service sector, which is the majority of the economy in developed markets. And also you've got the big element, which I know George will talk a little bit more about, which is China reopening. And as we've seen with other Western economies that have reopened, you get a big surge in demand. A lot of cash built up in Chinese households and just the ability to move much more freely around the country. We expect that to be a boost for the Chinese economy, and that might have a knock-on effect in terms of demand side inflation, but also the flip side of that is it will probably help to continue to ease supply chains around the world. So 2022, I'm sure you'll have noticed, and we spoke about it a lot last year, a very bad year for both bonds and equities, and therefore a bad year for the majority of investors. But with interest rates rising and you can now get a reasonable yield on bonds, that probably reduces the probability of having another very poor year for investors in 2023. Of course, nothing at all in this area is guaranteed, but the historic data would tell you it's actually quite rare for a bad year to be followed by another bad year. So moving on, we talked about interest rate cycles, and you can see there the little red box which just signifies 2022. It's actually been quite an aggressive rate hike cycle, and here we're looking at the US Federal Reserve interest rates in the US, but the same can be said pretty much, if a little bit delayed. The same can be said for the UK and Europe, and you can see that that bold blue line has gone up quite steeply when you compare that to other interest rate hike cycles over the sort of second half of the 20th century. And why has it been quite aggressive? Well, that there is this feeling that the Fed was pretty much behind the curve. They were a little bit late starting this cycle, because there was this big question about whether inflation would be transitory. Were we seeing inflation simply because we'd had the pandemic, we'd had the lockdown, and then you'd had the big reopening, and demand wasn't matched by supply because all of the supply chains were all out of kilter, and everything was, for want of a more scientific term, a little bit haywire. So that debate never really got resolved, because of course what happened around about a year ago was that you had the Russian invasion of Ukraine and everything that meant, particularly for energy and energy prices. So behind the curve a little bit late in starting, but also scarred by the experience in the 70s, when the criticism was that it was too slow and not aggressive enough. And you can see the longer blue line there, 1976 to 1979, albeit it went higher, it took quite a long time to get to those levels. So I think central banks are a little bit nervous that they didn't want to have a repeat of the 1970s. So that's why it's been an aggressive rate hike cycle, and that's why we had quite an aggressive sell-off in markets last year. So just to look at that in particular on the next slide, you've got here returns from bonds on the horizontal axis and returns from equities on the vertical axis. And you can see that generally in most years you're getting positive returns from both of those asset classes. But where you're getting a negative return from equities, generally speaking, you're still getting positive returns from bonds, and vice versa. The outlier there is clearly circled as 2022, when you've got negative returns from bonds coupled with negative returns from equities, and the magnitude of those losses is pretty significant. And that's not too difficult to understand when you appreciate where we've come from. This ultra loose monetary policy, very low interest rates, and huge amounts of liquidity being pumped in via quantitative easing. And everybody sort of knew that had to come to an end at some point. Nobody was quite sure when and how it would be done. In the end, central banks' hands being forced by the inflationary environment, and you move from this situation where there's lots of money chasing very little return and therefore ending up in equities. That is taken out when interest rates go up, and at the same time, the fact that interest rates are going up means that bonds that people own become less valuable. So goes without saying, a pretty rotten year for investors last year. So probably best that we move on from that. And as I said at the start, we now have yields that look reasonably attractive if you are a fixed income investor. So the chart on the left hand side only starts at the start of 2018, but if you were to go back a little bit further, maybe 3 or 5 years further than that, that sort of low flat line was in existence in that period too. So very difficult to get a return lending to corporates. The light blue line on the left-hand chart is lending to corporates who are considered to be very creditworthy, what we call investment grade, and then the dark blue line being those that potentially smaller, a little bit more volatile, less creditworthy, used to be known as junk bonds and now more sympathetically known as high yield. So in both cases, you can see, apart from that spike in high yield when everyone got very nervous around the pandemic, very low levels of return, And then as you've got interest rate rises in 2022, those yields rising quite significantly to the point now where you can get about 3.7 lending to investment grade companies and over 9% lending to high yield companies. So albeit inflation is still quite high, there is this expectation that it will come down, and therefore these yields on these loan instruments starting to look reasonably attractive. Right hand chart just shows you that has already started to be noticed by markets. So you can see what we're looking at here is what we call the spread. So that's the difference in interest you get between lending to a corporate and lending to the government. And obviously when you lend to a corporate, there's more risk associated with that, and you expect some compensation for that risk. And therefore, that's what we call the spread, that level of difference in interest rate between the two. And you've seen that start to go up throughout 2022, but actually reasonably quickly in more recent months, people moving into the bond markets, whereas previously people felt bonds were uninvestable. You've seen a big shift into bonds, and hence those credit spreads coming down. So what do we know about interest rates? Well, I've mentioned a couple of times already that we think the rate hike cycle is coming to an end, and we can see that on the next chart. You've had a narrative going throughout last year where investors, markets didn't really believe what the Fed was saying to them. The Fed has been quite consistent throughout all of last year, saying we're going to raise rates, we're going to raise them significantly, and we expect a terminal rate, i.e. the point at which interest rates top out, to be higher than markets suggest. So markets have been playing catch up throughout the whole of 2022, expecting the Fed not to carry through on its promises and being disappointed. And that's been supported a little bit by resilience in a number of developed market economies. So that chart obviously moving from left to right, going up as markets come to terms with the fact that the Federal Reserve is very serious about raising rates. There is an old market adage, don't fight the Fed, and I think a lot of people have learnt that over last year. But then you get towards the right hand side of the chart and you can see that's very much leveling off. The Fed and markets are pretty much in tune now in terms of saying, thinking that they've done enough, the economy is definitely cooling, and therefore we expect interest rates to level off in the next few months. What happens thereafter is still up for debate. If you think about the narrative from last year, it very much was the Fed will raise rates and then the economy will slow. And in the second half of this year, rates will start to come down again. You read a lot of year-end outlooks from investment banks and other economic commentators. That narrative is starting to change now, where a lot of people are thinking that rates are going to stay at this level for a period of time. And that's not necessarily a bad thing, because as I said earlier, we really needed to exit this quite bizarre period where interest rates were so low and markets were just being supported by huge amounts of liquidity. So that's where we are on interest rates. Don't fight the Fed. I mentioned good returns in the back end of last year. What does that actually look like? Well, on the next slide, you can see that it was reasonably encouraging if you just concentrate your mind from the 1st of October onwards. Left-hand side, the big beneficiary last year was emerging markets. Some of that is associated with this expectation of China raising rates. A lot of it is to do with the fact that the dollar sold off quite a bit in that quarter, and emerging markets are very sensitive to the dollar price and tend to do very well when the dollar falls. Not far behind emerging markets was Europe. Most of that associated with the fact that you had a very mild winter in Europe, and this real concern that the European economy was going to suffer because of the situation with its access to energy supplies, not least from Russia. The fact that we had a very mild winter really helped to alleviate that concern, and you've started to see a significant appetite for European equities off the back of that. I think the final thing that I'll say on this is it's notable, if you look at emerging markets and everything else that is US associated, just how different the returns have been for a US dollar investor compared to a sterling investor. So if you look at US equities, for example, if you're investing in dollars, you've got more than 9%. If you're investing in sterling and bringing that back into sterling with no hedging, you actually made a loss of about 1.7%. And we talked about this, I think, on our last webinar, that we thought the dollar was overvalued and we thought it was going to sell off. And indeed, we've made changes to our portfolios to reflect that view. And indeed, that's absolutely what has happened. So within our portfolios, if you are a client of ours, you may well know that we hedge about 50% of the currency exposure that we have in overseas. And if you hadn't done at least that, then you would have had a much more disappointing return than you otherwise might have enjoyed. So a little bit of optimism for the back end of this year. That's largely carried into this year. But I will hand over to George and he will tell us whether we can continue to be optimistic. George, over to you.
I'm not sure if I'm the right person to do that, David. But hi, everyone. Before I start, David shared a slide he showed that last year was really a lot about bonds. And I know that bond markets are difficult. A lot of the bonds are traded, they say, over the counter, not like proper stock markets. And there is yields and durations and maturities and some notions that I found even chief investment officers it's difficult for some chief investment officers to deal with. The problem was with the bond market. And part of it was that late last year, so late in 2021, the year before that, bonds were yielding next to nothing, and we had inflation in front of us. And as David said it, we had the Fed that could not really be easily predicted because it did an about turn versus its own policies from 14 years before. That's why investors didn't believe it. Until they became more sure about its intentions. So the thing is that the Fed did one of the most abrupt rate hike cycles in recent history. And our concern has always been not that bonds would re-rate. We expected that. That's why we adjusted our portfolios in early 2022, but rather that it could break something. Okay, putting up rates so high was risking breaking something in the financial system. So before we started this meeting, I took a look at some financial risk indicators like high yields in Asia and what have you. And I won't bore you with many charts, but from what I was looking at, European risk indicators like credit default swaps, what investors pay to as an insurance to buy a European bond, or high yields in China, which yielded up to 30% a few weeks ago. And they've all come down markedly. So from where I stand, more or less, as we're nearing the end of the Fed rate hike cycle, the Fed, if it hasn't won, then it's winning. We're going from triple rate hikes to single, i.e. 0.25%. And it has the ability to take its foot off the pedal without having triggered a global financial crisis. It hasn't broken anything. And this is a very big win. Investors are slowly or more quickly returning to bond markets. And the reason behind that is not the Fed's great communication over the past, few months. I think that was that could have been better. I think it's all the residual liquidity in the system, all the money it has already printed over the years, and it is also more safeguarded systems. Banks became more boring. They're not so prone to or in danger from financial volatility. So now it's a more safeguarded system. So after 14 years of the Fed building that up, it really created a system that was resilient, a financial system that was way more resilient than it was in 2008. And now it just took the test. They said, okay, we have inflation now. Let's see how resilient the system is. And that takes a lot of courage. And this comes from somebody who's been highly critical of the Fed. So what are the spoils of this victory? In front of us, obviously, a more normalized yield curve, which could have many long-term economic benefits. Having said that, we're not out of the woods yet, because whereas the Fed hike rates without breaking anything in the financial system, the question now is whether something is broken in the economy. The risks are more economic. Economic risks are usually more easily handled, but it doesn't mean that what the Fed plans to be probably a mild recession may not evolve into a deep recession. Okay, so this is where the risks now, they're more economic, but the resiliency of the financial system after a very tumultuous year like 2022 is not something that anybody with an investment portfolio should take lightly. Okay, it proved that the system is strong. And if you're thinking about investing money, then that's definitely a takeaway here. So as you can see from this slide, we're now at the point where central banks achieved what they wanted, and they're reducing demand a lot, and the global economy is slowing down. Next slide, please. If you reduce demand enough, that is scare people from buying stuff, which non-Americans have done, by the way. We're going to talk a little bit more about it. Then demand is reduced, therefore inflation is coming off, and we can see this in most major economies. Having said that, China is reopening. So that's like one of the big risks in 2023. China remained it was a very increasingly open economy over the past few years. Then it closed abruptly because of COVID, but at the time it was also at the heart of the global supply chain system. And now after closing down shut, it reopened abruptly. And we can see producer prices picking up slightly in China. We can see much more inflation in its neighboring Japan, by the way. So the point here is that this is one of the key risks in 2023. If as China reopened very, very quickly, the question is whether it's going to cause more inflation or whether it's just going to be more beneficial to growth than it is a problem for inflation. And that we do not know. Because they've never really been apparent with the data, but also there aren't any models that you can be informed with. It will come down to the outcome might appear random, but it will come down to how goods move from Shanghai, what demand is from Chinese factories, and a lot of things that you cannot simply model. You have to wait to see how they play out. Now, next slide, please. Having said that, obviously, if and this is where the more benign inflation narrative comes from, if in the last 6 months, US inflation has risen by 0.2% per month. If they keep it up at this rate, inflation could be at 2% by June. This is the year-on-year effect. We think that we need to wait for China. And in fact, that's what we think the Fed is waiting for, or else it could have turned dovish a little bit quicker. But it is waiting to see what the impact of China reopening very quickly will be. Next slide. This is why it is not taking sorry. I missed a slide. So despite the fact that consumption in the US is weaker, and you can see US consumers have not been really buoyant in November and December, and also you can see that credit card delinquencies are rising. So what UK and European people did, they saw a crisis, they did not buy much, demand was reduced very quickly. That's why central banks didn't really have to hike as quickly as Americans. But Americans, they didn't see any reason why they should stop consuming, so they just charged everything to the credit card. A credit card for which they paid an interest rate of 20% a year ago, and now 2 years ago, and now they're paying an interest rate of 35%. So now delinquencies are beginning, and they really need to, they really push their cards to the maximum, and now they really need to cut consumption. And this is where we are with the Americans. Additionally, next slide, there is the housing sector disruption. We're seeing the sharper US housing slowdown since the European crisis in 2011. And obviously that has a wealth effect. If people's homes values are falling, then this will have an impact on how much money they're willing to spend. So despite these conditions, next slide, please, the Fed, it continues to drain money from the market. This is really what markets are now watching, not so much interest rate hikes, but rather how much money is it siphoning away from markets. And to be fair, with the exception of November, it's always siphoned less money than it could. So the light blue line, the light blue bar is how much money they said they would siphon away each month. Sorry, with the exception of November and August, they did much less. So whereas it's been pretty aggressive in hiking interest rates, in terms of siphoning money from the markets, removing liquidity from the markets, it's been a little bit more benign. Having said that, obviously it continues to tighten despite the worsening economic conditions, exactly because it's waiting to see what will happen in China. Next slide, please. I think we've showed this a number of times for those who've been on this call a few times. So we're in this recession clock, right? And we passed the inflation stage, central banks tightened, we went into the financial recession, that was all 2022. And now we're reaching the stage, we're at the stage of the economic recession. So we're right next to the next stage, which is either the recession becomes too pronounced or inflation drops enough to change the calculus. And central banks start talking about growth more than they talk about fighting inflation. We're not there yet. They're still hawkish. They're still raising interest rates. Not many Fed members have really talked about pausing rate hikes at a certain level, maybe one or two yet. So we're not near the so-called pivot, which is a more accommodative central bank. And there is a scenario out there where they don't really have to pivot in the whole of 2023, just because the system is ticking along nicely. I.e., just because markets are doing okay, there are no major financial risks. If the recession is mild, if unemployment doesn't pick up too much, it probably will, but just a little. That's the base case right now. Then we could still be far from the pivot where central banks become accommodative again, i.e. lowering interest rates and raising the amount of money in the system. And that could well be a 2024 story in terms of interest rates. In the meanwhile, what they're probably enjoying is the possibility of normalizing yield curves, which I understand are still inverted. Long yields are lower than short-term yields, but this should remedy itself after the economic slowdown. So why do we want steep yield curves? Because that's how credit moves. If you can borrow short-term and lend long-term, which is where you usually lend, that means you can give out more credit. That would mean more banks moving the economy a lot more, and banks and credit are the lifeblood of the economy. So we're not expecting accommodative conditions to mess this normalization and lower the yield curve until 2024, unless something breaks, unless there is a financial accident or the economy goes into a very deep recession. So that's the stuff we're looking at. Next slide, please. The question going forward, and this is a part of our quarterly, which I would encourage people to request and read it where they can, is really, it still revolves around China. China was the center of the global supply chain, and it is less so now. The West and China are at odds, and it's moving away from the role anyway as the world chip manufacturer. And the question in everybody's mind is this low macroeconomic volatility ushered in by a very helpful Fed over the past 40 years against a normal Fed, which is what we have today, and a China that's not there to just produce cheaper and cheaper goods. Will this result in higher macroeconomic volatility? Now, this is important. This is very important, because it's one thing saying, oh, I think inflation is going to be 4%. It's a very different thing saying, oh, I think inflation is going to be 4%, but before we get there, it's going to go as high as 6 and as low as -2, and then as high as 5, and then as low as -3. Okay, this is a very volatile environment, which could have a severe impact on businesses. So going forward, we're looking at three main scenarios. One, next slide, please. One is the scenario where in the next 3 years or so, we are back to normality in the next 1 or 2 years, i.e., for some reason, the West succeeds in moving some supply chains away from China and some of its dependence, like Germany managed to wean itself off Russian gas, for example, very quickly, and things are normalized, and we have cheap goods just being produced elsewhere and the infrastructure to deal with that. The second scenario, in essence, our base case scenario, is that this might happen, but it could take a good 3 or 4 years before we see it. And that is a scenario where we see increased macroeconomic volatility in the next 3 years, i.e. numbers jumping up and down a little bit more than what we're used to. And this is important. It's important for businesses, because that means bigger inventories, it means higher inflation structurally now, and that sort of stuff. And of course, there is the third scenario. I should not have named it World War Trade. Apologies for that. The name is Trade Wars. If we get trade wars, that could result in higher macroeconomic volatility, which could result in inflation peaking much higher and ebbing much lower, and to make things very difficult from a policy making standpoint. Okay, so this is the big risk that we're looking at. We know that the financial system is safe and sound. Now we're asking the same question for the economic system. Okay, and 2022 gave us the answer for the former. I get the feeling that 2023 will give us the answer for the latter. Now, meanwhile, the penultimate slide, a message I want to leave people with is that a bad year is usually followed by a good one. On the left-hand side, we have the performance of a usual 60-40 equity bond portfolio after a bad year. So on average, that is the light blue line, you get an average of 5.8% performance. After a negative year, the average is nearly double that, with the exception of what followed after the 2000 dot-com bubble. There have been good years after bad years, and this isn't just a random observation or by accident. The system has ways of keeping the money you lost, in quotation, in arrears. There is money waiting on the sidelines, and this could push valuations higher. Okay, that's how the mechanism works. So if you're looking at your portfolio and you say, oh, I lost X amount in 2022, there is a good chance, historically speaking, that you're going to earn that back within the next 2 or 3 years if you hold that portfolio. So The final takeaway slide. 2023 is not projected to feature very aggressive rate hikes. We're very close to the end in terms of the Fed. Having said that, we could continue to see volatility for some time. And that's something maybe we might have to get used to in the next few years anyway. The X factor right now for 2023 and most scenarios is China and its reopening. You know, whether this is beneficial for growth or whether it's worse for inflation, we just don't have the outcome for that particular calculus yet. A final takeaway is there is one thing, you know, in 2022, things look bad because it was bonds falling alongside equities. There's very little chance of that happening. There is little chance of that happening in 2023. And that is because there is already a lot of yield in bonds. That's why people are returning, especially if they see evidence of a more sound financial system. Okay, and that's the big takeaway. Diversified portfolios did not have had a very bad year because both major assets dropped, but because now bonds have a yield, it's very difficult to see the same picture again. I'm not saying it's impossible, nothing is impossible, but in terms of probabilities, this is not a very high probability scenario. So I'll leave you with that because the return of yield and the potential normalization of the yield curve could be great news for investors going forward.
Thank you very much indeed, George. We've got a few minutes, so we'll squeeze some questions in. You talked then, George, about sort of returns being in arrears and cash sitting on the sidelines, and that making it more likely for better returns this year as that money returns into markets. But it's probably fair to say there's no guarantee that money goes back into the markets that it originally left in terms of sectors and geographies. So let me turn to this question from Alex, which is actually a very opposite question in terms of the things that we and our competitors are considering. And the question is this: with reduced appetite for technology stocks, do you see a wider rebalancing away from US stocks towards other instruments or markets in the midterm?
For our portfolios, we rotated away from many of those growth stocks and managers who favored them, obviously. So this is a very valid point. Will we be in? So we paid 80 times Apple's earnings and 1,000 times Tesla's earnings because there was a lot of cheap money out there and the Fed would always be printing more. Now we're in an environment where we at least know the Fed will not be printing more in the near future. At least that's what they're telling us. So how can we put money and pay 1,000 times Tesla's earnings? So that rotation makes sense. We do see a general shift towards quality. You know, people call it value sometimes. Value can be buying something dirty cheap. So I'd rather stick with the quality and say people prefer qualitative companies. They've returned to more investment fundamentals. The reason I'd not touch upon this is great news for us as investment professionals. I can use my knowledge to sort of try and predict what company looks good, what company doesn't. But if the market is placing undue faith in a meme stock, then all my knowledge goes out of the window. Okay, so this is we're returning along with the potential yield curve normalization. We're returning to a more normal market, which is good for people who have portfolios with experts, because now those experts will find it easier to do their job.
Super, thank you, George. And as we've seen in the first part of this year, we are having a lot of conversations about whether there is a move away from the US into European markets, into Chinese markets, and indeed Asian markets generally. Straightforward question, we talk a lot about inflation and interest rates, and a lot of the interest rate hikes that we see are associated with the cost of energy. So the question is how would the end of the war in Ukraine affect the markets?
I think obviously there would be a knee-jerk effect, a very positive knee-jerk effect initially. And having said that, I'm not sure how further down we can see oil prices. Oil prices should move between 70 and 90 because that's where Saudi Arabia basically wants them to be. So we're sort of in the middle of that range. So the immediate effect would be good, and I would expect to see all risk assets bounce back. Over the medium term, however, right now my attention is more in China. Ukraine is more or less priced in, whether unless it deteriorates significantly, Ukraine is right now more or less priced in. What's not priced in is the end of the war. So an improvement, and then we shift on to the next risk, which is China.
Excellent, thank you. Probably time for squeezing one more question. I'm not sure we've spoken too much about it today, but it's certainly a topic of conversation within our team, and that's about the housing market. And you've seen some very big slowdowns in the US, and we expect to see that coming through as well in the UK. So just a question around that, what is the outlook for that sector, and given that the housing market plays a big part of the UK economy?
So first of all, let us assume, to answer this, that the UK government does not intervene further, because obviously the outlook was bad during COVID, and then they intervened with a stamp duty tax. So that resulted in a lot of demand for new homes. So now we're at the point where those new homes have already been bought and taxes are coming back. So let us assume that there won't be any more easing measures, and the outlook is generally not very benign in the sense that we're already seeing a sharp slowdown in US homes. We're probably going to see a sharp slowdown in European homes as well. So this is more of a global thing. We already saw it in China 2 years ago, 2 years running, I'd have to say. So it makes sense for the UK to follow. Why? Interest rate hikes. Somebody who just had their mortgage, who had to remortgage, they went from 1% to 5%. They're not happy about it. If you're a new home buyer, you might wait to see if interest rates peak and then fall. So it makes sense for somebody to wait for that decision, which means less demand for homes. The supply would remain the same. So all other things being equal, prices should fall. I think in the UK market, and what we've been observing, we're sort of reaching the point where sellers don't really want to sell at lower prices, and bidders won't go far enough to reach them. This eventually makes this into a buyer's market rather than a seller's market, which is what it has been for the last 15 odd years. And that reversal could result in lower prices. Because it's the UK market and because there aren't enough homes, I don't think it's going to be as sharp as the US, where it's easier to build in the suburbs and all that. So I wouldn't expect a dramatic 30% drop in prices in a year or something like that. But I think we could see a significant material slowdown in UK prices.
Excellent, thank you, George. I mean, I think you're right. The density of the UK population does have a big bearing on how the housing market operates, but that notwithstanding, we are expecting to see that having a negative impact on UK PLC. Excellent. We're out of time, so we'll leave it there. Thank you very much, George, for your inputs. Thank you, Harry, for working the technology for us. But most of all, thank you to you for choosing to spend your time with us this morning, and we hope to see you on our next webinar. Thank you very much.